Hey everyone, welcome back to the channel. Today we're diving into a topic that seriously affects your wallet: inflation and interest rates in the USA. Why are prices going crazy? Why do mortgage rates feel like a punch to the gut? Let's break it all down. Simply, clearly, and quickly. Let's go. First, what is inflation? In plain English, inflation means that prices for goods and services are rising over time. A gallon of milk that cost $3 last year might cost $3.30 this year. That 30-cent jump, that's inflation at work. A little inflation, around 2% per year, is normal and even healthy for the economy. But when inflation gets too high, it can start hurting your paycheck. You can buy less with the same amount of money. And that's when things get tricky. Okay, so why has inflation been such a problem recently? It's a mix of things. First, COVID-19 scrambled supply chains, factories closed, shipping slowed, and suddenly, there weren't enough goods to meet demand. Second, the US government pumped a lot of stimulus money into the economy to keep people afloat during lockdowns. That extra cash boosted demand even more. Third, the Russia-Ukraine war made oil and food prices spike. Put it all together, and you get a perfect storm of rising prices across the board, from groceries to gas to rent. Now let's talk about interest rates, the Federal Reserve's main weapon against inflation. Interest rates are basically the cost of borrowing money. When the Fed raises rates, borrowing gets more expensive. Mortgages, car loans, credit cards, they all get pricier. And when borrowing costs go up, people and businesses spend less. Less spending equals less demand, which means slower inflation. In theory, anyway. As of early 2025, the Federal Reserve's benchmark interest rate is sitting between 5.25% and 5.5%, some of the highest levels we've seen since the early 2000s. For perspective, just a few years ago, it was basically zero. This jump has cooled down some parts of the economy, especially housing. Mortgage rates have soared to over 7%, making it much harder for first-time homebuyers to afford a house. Okay, so why should you care? Well, high interest rates mean credit card debt gets more expensive, car loans cost more every month, and mortgages are way pricier. But there's a silver lining. Savings accounts and CDs now offer higher returns. Banks are paying you more to save money, which hasn't been the case for a long time. So, what's next? The Federal Reserve is walking a tightrope. If they raise rates too much, they could tip the economy into a recession, meaning layoffs, slower growth, and a lot of financial pain. If they don't raise rates enough, inflation could stick around longer and keep squeezing consumers. Right now, inflation has been cooling down compared to the crazy spikes of 2022 to 2023, but it's still above the Fed's 2% target. Experts predict the Fed might start lowering rates later in 2025 if inflation keeps trending downward. But nothing's guaranteed. It's all about striking the right balance. Let's dive deeper into how inflation and interest rates impact different sectors of the economy. For instance, in the housing market, high interest rates can make mortgages more expensive, reducing the number of people who can afford to buy homes. This can slow down the housing market and make renting more competitive. In the stock market, higher interest rates can lead to lower stock prices as companies face higher borrowing costs. Investors often shift their money into bonds, which become more attractive as interest rates rise, causing stock prices to drop. On the other hand, sectors like banking can benefit from higher interest rates as they can charge more for loans. This can lead to higher profits for banks, even though consumers might feel the pinch. Understanding these nuances can help you make better financial decisions. Whether you're considering buying a home, investing in stocks, or taking out a loan, knowing how these factors interplay can give you an edge. Stay informed and make strategic choices to navigate the economic landscape effectively. Bottom line, inflation and interest rates are two of the biggest forces shaping the US economy right now. Whether you're shopping for groceries, saving for a house, or investing for your future, they matter. Stay informed, stay smart with your money, and you'll be in a better spot no matter what the economy throws at you. If you found this helpful, give it a like, subscribe for more breakdowns like this, and drop a comment. How have rising rates affected you? I'd love to hear your story. Thanks for watching, and see you next time.